Hi Forex Gelt lovers. We welcome you back again to our channel. Today, we'll be looking at the topic, applying Forex market analysis. Introduction. It is important to think critically about the principles of Forex market analysis. Here is a 4-step overview. 1. Understanding the drivers. The art of successful trading relies in part on understanding the current relationships between markets and the reasons for those relationships. It's important to have a sense of causality and remember that these relationships can and do change over time. A recovery in the equity markets could be explained by investors who expect an economic recovery. These investors believe that companies will achieve better returns and therefore higher valuations in the future. So it is a good time to buy. Due to an avalanche of liquidity, this could add momentum, and old greed is driving prices high until the biggest players are on board for sales to begin. Hence, the first questions to ask yourself are, why are these things happening? Behind the market actions? 2. Representation of the indices. It is helpful for a trader to graphically represent the important indices for each market over a longer period of time. This exercise can help the trader determine the relationships between markets and determine whether a move in one market is reversed or in line with the other. For example, gold was pushed to record highs in 2009. Was this a reaction to the perception that the value of paper money was falling so quickly that carbide had to be resorted to, or was it the result of cheap dollars that sparked a commodities boom? The answer is that it could have been both, or as we discussed earlier, market moves that were driven by speculation. 3. Seeking consensus in other markets. We can gain insight into whether or not markets are reaching a turning point consensus by subscribing to other instruments on the same weekly or monthly basis. From there we can use the consensus to start a trade-in of an instrument that will be affected by the turnaround. For example, if the USD-JPY pair indicates an oversold position and the Bank of Japan, BOJ, intervenes to weaken the yen, Japanese exports could be affected. The recovery is likely to be hampered without the yen weakening. 4. Time trading. There is a much higher chance of a successful trade by finding turning points in longer periods and then switching to a shorter period to adjust an entry. The first trade can be exactly at the Fibonacci level or double below, as indicated on the long-term graph, and when that fails, there is often a second chance with a pullback or test of support levels. Patience, discipline, and preparation will set you apart from traders who simply trade on the go, with no preparation or analysis of multiple Forex indicators. Conclusion: there is no best analysis method for Forex trading between technical analysis and fundamental analysis. The most viable option for traders will depend on their time frame and access to information. For a short-term trader with only delayed information in economic data but real-time access to quotes, technical analysis may be the preferred method. Alternatively, traders who have instant access to news reports and up-to-date economic data may prefer fundamental analysis. In any case, it doesn't do any harm. Do a weekend analysis when the markets are not in constant flux. Thanks for watching and kindly subscribe to our channel.